Hello and good afternoon. Welcome to an ad hoc update that we've decided to record today. We had an excellent day in the office so far. We've had Henry and Scott up from Elston. We have got our client conference at the end of January. We've got a good number of clients who've registered so far. Anyone watching this who hasn't yet registered, please click on the link that Sky sent across for you to join up for that. We think it's going to be a great day. Henry will be speaking then, but right now I'll pass you over to Henry to give an update on 2024 so far.
Great, thanks for having me, Chris. And yes, just a quick little update as we get towards the end of the year. And I think really just taking stock on the kind of key asset class performance. So this is as of Friday, the 22nd of November, the asset class performance for each of the asset classes. So green is all equities, orange is alternatives, and blue is bonds. And I think what really stands out, Chris, is that this has been a year for US equities again, with US equities up 28%. And because US makes up such a large part of global equities, it means the global equities are up 21%. You'll see UK has had a pretty okay year, up 10%, but that pales in comparison compared to the US. Looking all throughout the year, we've seen a really interesting pattern emerging, whereby the UK has gone up when the US has gone down, and the US has gone the other way around. So it's been a really good diversifier against US equities, and at times whenever the US has dropped, UK has done really well. So that's been a really useful reason to hold the UK alongside the US for equity markets across the year. But now as we look forward, we need to think, well, it's all about earnings, and the earnings growth trajectory for the US is much, much stronger than it is for the UK. And that's partly reflected in the price so far. We've had earnings growth throughout the US all through this year, and that's likely to stay into next year as well. We'll touch that much more at the client conference in January. So yeah, a good year for the UK, the FTSE 100, but a great year for the US. And that has really powered on even further following the Trump win, and we'll come onto that in a moment. What are the other asset classes? If we look at alternatives, the big key standouts have been gold and precious metals, which are up 28.6% for the year, and listed private equity managers up 29% for the year. So these alternatives are diversifiers. They're something that often we consider and discuss for the alternatives part of the basket. But gold has been really strong because of the fears around the US Treasury market, but also fears about geopolitical risk, the kind of Russia-Ukraine war and the China-Taiwan fears. And also because central banks have been, emerging market central banks have been buying it in bulk. So that's been, and it's quite sad to note, Chris, that the gold price has now hit 10 times what it was when Gordon Brown sold off the gold reserves, which I remember back when I was younger, the motorcades driving through the city of London as they literally just got rid of all this gold. So that's quite sad. Within bonds, I think the standout area is emerging market debt, where that dollar exposure of emerging market debt has been a big supporter. And obviously, ultra short bonds are in line with kind of cash rates. So yeah, high yield EM bonds and money markets have been the interesting areas. But as a whole, you can see just from the chart, bonds move around a little bit, but they're really just there to underpin portfolios. The growth engine is the equity side, and within equities, it's been the US.
So quick question there. I came down to your office in December when you did a presentation about what you thought the key themes for 2024 were going to be. Have you been surprised how good returns have been this year? Are you still concerned about risks that you thought existed December last year as we go into December this year? I mean, where are you at with regard to performance and risk?
So really good question. And actually one of the slides we've got looks back to that outlook. So at the beginning of the year, there was a big, so if we rewind to November 2023, when we had that outlook year for 2024, there was a split opinion of will there be a recession in the US or not. And some were saying there's going to be a recession, and I was saying, no, there won't be a recession. And the market was divided about whether there wouldn't be. And what happened in the first part of the year is, if we look through 2024, we can almost see three phases. First of all, there was the AI boom. This February. It's like, oh gosh, this thing called AI that's going to transform earnings. And the big tech companies started growing their earnings, and this huge revolution that dragged the top of the equity market higher, because the tech companies make up a large part of the US equity market. Then the second wave was actually, this is the less trumpeted, was that the US economy growth, the GDP growth rates were gradually upgraded. So everyone thought the economy was going to be quite soggy. Then it got upgraded. Now it actually looks resilient. It looks like instead of being a recession, it might be a soft landing, and now it's what they call a no landing. And in fact, it's just growing. So that economic upgrade was really good news for US markets. And that's where we also talk about the broadening of the rally, where suddenly, previously, all the earnings growth was just in tech, and the rest of the S&P 500 wasn't doing very well. But now the whole of the S&P 500, all the earnings are recovering. So there's positive earnings growth across the board, and that's called the market broadening. So there's three phases of the US this year. First was the AI boom, second was the GDP recovery, and third was the earnings recovery. And all three stages have pushed markets on. The big thing, I think, which we had as a theme last year, and maybe that'd be a good slide to show, January, is the last year versus this year ones, was about perfecting the pivot. We knew that the Fed was going to cut rates. We just didn't know when. So it's all about trying to time that time when the Fed would cut rates, as that would be a good news for the equity market and also good news for the bond market. And we thought it might be mid-year. So back in November, December, we thought it might be sort of May, June, July 2024. In the end, it was July, August end that they did the first rate cut. And that's been a big support for the markets as well. So I think the thing that changed most was GDP was better than expected. The rate cut came as expected. And the inflation story, which was the other kind of concern, that's still there in the background. And the other thing was geopolitical risk. And I'm afraid we have had an awful lot of geopolitical risk and continue to do so. Yeah. What about outlooks? This is our quarterly outlook for up until the end of December. We'll have a fresh one when we come and speak in January. But our key themes for this quarter at the moment is a steady step down in interest rates, finessing what we call a soft landing in the US economy, and obviously changes in the West Wing. So a steady step down. The pace and depth of policy easing could diverge between the US and the UK. Growth is actually much stronger in the US than it is in the UK, while inflation is much stickier in the UK than it is in the US. So although the US and the UK raise interest rates at the same time and the same speed, they'll be lowering them at different speeds and different terminal rates. And also the other interesting thing was in the course of 2024, there was a gap opened up where the relative rate for the UK was higher, so a higher expected interest rate for the UK compared to the US. Sterling appreciated in that moment, and that's now disappeared. That kind of gap has narrowed, and they're now, you can see from the chart, they're expecting to, by the end of the year, just under kind of 4% interest rates, 3.75, and next year we'll refresh this chart in January as well. Yeah. So the interest rates, they're not going to go down to the floor. They're going to be very gradual steps, because at the end of 2025, we're expecting just under 4%, but it's not it's not a slashing rate, it's not a cutting rate, it's a steady step down in interest rates.
And do you think the inflation numbers that came out last week will slow the pace of change with the Bank of England?
So that chart changes literally every data point. So every day that chart changes. In fact, that's just a snapshot at a particular point. Yep. And yes, because the inflation was a bit higher, that meant that the Bank of England is less likely to cut rates more dramatically, and therefore they'll carry on with this wait and see approach. Yep. And we think inflation in the UK could tick up a little bit. And we don't think it's going to rocket up like it did in the Ukraine shock. So we see this as a kind of 2% being the target, but we see that being a floor, not a ceiling. And we think it'll be kind of bumping around in that 2 to 3, something called that is under control, but it's not under the target. Mm-hmm. I think this is a chart, actually, Chris, you remember, we did actually went through this back in November, December. This is our outlook chart from last year. And back then, you could see you had US growth rate for 2023 was just over 2%. And then the range of estimates for 2024 was something between the red line, which is -1, and the green line, which is +2. And the base case estimate when we did the outlook this time last year was that the US would decelerate, it would go from just about 2% down to 1.15%. And what actually happened in the actual fact was that number's been upgraded, whereby now currently we're looking at growth actually accelerating to +2.6%. And that's been a massive, massive shift, where it's gone from, will there be a recession or won't there be a recession, to actually the economy's growing robustly and warmly. This is fantastic. And that's why the US economy has been doing so well. And that's been part of the reason why US markets have done well. Strong economy, strong earnings, lower interest rates. So that's the kind of the good news for the US. And because the US is a large part of the global economy, that's good news generally for equities. And the final thing, obviously, is we saw is change in the West Wing. And I think, Trump is a divisive character, but it was a very decisive win. And that decisive win is good news, because it means there's people were worried about the civil unrest. The people were worried, will they accept the result? Or what's going to happen if the Democrats win? Will these Trump supporters all go crazy? So the fact that there was actually a decisive win means that actually that geopolitical risk has evaporated. And now people are focusing much more on the US economic fundamentals. And, love him or hate him, this has been good news for US equity markets, and particularly the so-called Trump trade areas. So financials for deregulation, energy for dirty energy and materials and industrials as well for the kind of America First strategy that he wants to adopt and bringing production back home. So it's kind of one of those things whereby, regardless of your politics, this has been good for the US equity market. And next year, it'll be very much about what happens to US debt, because that's a problem, whether it be a Republican or Democrat administration, the debt problem is a problem. The other thing is what's happened to the economy. If it's growing so strong, does that mean inflation comes back a little bit? It'll never come back to that sort of 10, 11% shock we had with the Ukraine war, but it might just come back a little bit above target. And then finally, where is the equity market recovering? So the tech has been very strong, is now broadening, and we see earnings growth across the whole US equity market, and that's really underpinning the kind of America First view when it comes to equities as well. So it's been a complex year. All years are complex, but this has been continuing this whole, what we called last year, kind of poly crisis. Hopefully we're coming out of the poly crisis, and hopefully you can look forward to a slightly better, calmer 2025. But that's not something one can actually predict, but it's something we can definitely hope for.
Definitely. The hope for growth and hope for low risk, low volatility markets. And sometimes you do get what you want. It's been a very tricky 5 years since COVID came to the world. That's another topic we are going to discuss in our annual conference, is what we've actually gone through over the last 5 years and how we've come out the other side and how markets look differently now. The main thing from that is the clients watching this who've been clients all the way through, stuck with the process, stuck with the belief that markets recover, and you invest in the right areas, keep updating those investments, and long-term growth will hopefully be there forever. So thanks again for listening to another update from ourselves. Hope we see as many of you as possible at the client conference at the end of January. And so if you haven't yet registered, please click on the link to do so. Thank you.
Thank you.